You know what time it is now, right, buddy?
Oh, I'm ready to get our minds blown.
I see some new faces in here, and I hope you're ready because it is the time to go live on Facebook for the Not Your Average Investor Show Thursday edition rental property of the week.
Week.
Yeah, pow! I am your host, Pablo Gonzalez. With me, as always, the man they call GC because this guy crushes, and because his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Welcome to the show. So happy to be here on a Thursday. We missed last Thursday as we were all eating turkey, but nothing quite like the Thursday gang here.
Nothing like the Thursday gang. This is really, on Tuesdays, sometimes it's me and you, sometimes it's me, you, and a guest. So it's kind of variable, but these Thursday calls really is us talking numbers, putting out value, really teaching people. And it's our group of friends that show up here every Thursday. We got some new friends this week as well. I see Byron Ross here for the first time. Well, somebody else said that they were here for the first time. It was Karen Jensen is here for the first time. Happy to have you here. You will learn from our usuals here that this is an interactive show, and there is two ways to interact with us. Number one is through this group chat that you are already using, but there's a little trick to the group chat, and that is that when you first start, it is defaulted to that little blue box on top where you chat, says all panelists only. You got to drop down that blue box and put panelists and attendees so that everybody in here can see your comments, everybody can share, and we can all be friends with each other. And then second is if you want your question, you're going to notice that chat moves real quick, right? Like there's a lot of people contributing. There's some really educated investors in here providing value, existing clients that have been with us forever, fans of the show that have been here every week. They're going to be adding a lot of value in there here also. But we also have that Q&A box. That's the best place to go to get your question answered, your specific question answered, if you want me to ask it to Gregg. So I'm seeing right now, Robert Perusina, welcome, good morning. Ken, welcome, good morning. This is a perfect example. You guys are only chatting to me and Gregg. I would love it if you hit that blue button and drop it down to panelists and attendees. Just check that out. David Berktold, you're also only speaking to us in the chat so that you guys can all start to get to know each other and we can have the wisdom of the group here. And last but not least, if you are here for the first time and you want to, zoom out and find out about all the great things about rental income properties, the three things that you got to nail to be successful in this asset class, go to jwbwebclass.com, where Gregg put together an awesome webinar that includes a free investor toolkit that comes with the property sheet that we're going to, not the one that we're doing, but you get the template so that you can tinker around like I'm going to be doing around with this Excel sheet. And second of all, if it is time for you to move into that next phase, you want that personalized plan, you want to get on a call with a team, go to chatwithjwb.com, pick out the best time for you, jump on a call with the team, and it's going to be sweet. I recently have gone through the experience myself. As people know on this show, it's a well spent, however much time you get with Courtney or the mics, you're going to enjoy it because it's all about you and about building your own plan. But without further ado, Gregg, we are now going to be magically whisked away to 1211 Crestfield Road, which is our property of the week.
Week.
There you go. Just keep it under. So this is a property that generates 9% estimated return on investment, is already rented to a resident with a 2-year lease in place, and comes with $4,800 in additional rent credit given to the buyer at closing. And we're going to get into all of that as soon as I share my screen. But Gregg, this is one of the original properties that you guys bought, right? Tell me about that.
Yeah, can you see the tear in my eye here for this property here? Yes, I remember purchasing this home back in 2008. This is one of those 40 rental properties that I've spoken about a number of times that my business partners and I acquired very early on. We started buying rental properties really at the height of the market. And as you can tell here, we were doing it even in 2008 while the market was starting to really fall. And so many people ask, well, why were you doing that? And, what happened to those properties? Well, what we talk about on this show are the time-tested fundamentals that will serve you well when it comes to rental properties. And it's all about buying assets that pay for themselves. It's all about buying and holding for the long haul. And then it's about using debt the right way. And this one, we did something a little bit peculiar, a little bit unique, used a strategy for debt that maybe we can kind of talk a little bit about that, because I think people will get a little bit of interest in that. But this is one of the ones that we bought in the beginning, and now we're making it available for our clients to purchase as well.
I love the full circle of this, right? Because you've talked a lot about how you and your partners bought in at the top of the last market and how you still own them, and you're still, like you still own those 40 properties, and how you were living in this alternate reality where everybody that was in real estate and as the market crashed in 2008 was freaking out while you guys were sitting there looking at your bank account and thinking, I still got cash flow coming in. What's going on? It's all working.
Yeah.
You know, Gregg, I want to live up to the promise that I gave David last week, and I told him that this call was all about him, and to join us, he came ready for a question, man. Let's dive right into this question, and then we'll go into this property. Is that good?
Cool. Let's do it.
So David writes, talk to Courtney and have an onboard meeting tomorrow. Congrats, David. That's exciting. Got a question for you all. How do most of your investors take title on your properties? Any recommendations for me with my situation below? I created an LLC for passive income purposes, but learning most lenders won't allow title and deed in name of an LLC for investing properties using conventional financing. I think options, hence, are to deed investment properties into a revocable living trust, private name, and get umbrella insurance to protect against liability, or to retitle property into LLC after closing. Maybe lenders allow title into real estate investing trust as another option. Any sage advice?
Well, I don't know if it's sage advice, but I've done everything that you just listed there as the options. And, I can talk you through what we did, why we did them, and then what a lot of our clients do as well. So you're right. There's a conflict between using an LLC and then getting the most advantageous terms for financing, David. So conventional lenders, the vast majority out there, just won't allow you to purchase your property and get a loan in the name of an LLC. They need it to be in your personal name. So that really creates a challenge for those who want to use financing like we talk about, because it's a huge tool to be able to grow your portfolio. But, you also want to have asset protection, and that's where the LLC comes into play. So I'll kind of go through a couple of your ideas here using trusts. I'll keep it pretty simple because I could go on for hours and hours and talk about this. Trusts are a solution for you. However, it still will pose challenges for your conventional financing lenders. You'll have some more lenders that will allow you to do it, but the overall majority will still create challenges for you. So I wouldn't go down that route, at least right off the bat. Don't do that. You generally, in order to get the best financing, you're going to need to keep it in your personal name to be able to get the loan. After you get the loan, after you buy the property, you get the loan in your personal name. If you want to move it into a trust or you want to move it into an LLC at that point, that's where most investors, if they do move it into an LLC or a trust, that's when they do it. You get the financing, then you can then get whatever asset protection that you may need. For the 40 properties that I bought right off the bat, David, that we're talking about Crestfield here, for those initial properties, I actually did not put it into an LLC for, probably the first few years, maybe 5 years. I don't remember when I eventually put them into an LLC. I kept them in my personal name for a long time. And so I would say that it's dependent on your risk, how much risk you want to take on. There are some investors like me when I was 23 and buying rental properties, where I looked at the idea of buying properties in my personal name, getting the benefits of financing, and then the ease and the lack of cost that you would have when you keep it in your personal name long-term as a big benefit for me. And the way that I protected myself was through great insurance. And so, there are many investors that will keep the property in their personal name, work with a great insurance broker, make sure that they have the adequate insurance and then some. And that's what my business partners and I did for the first, 40 rental properties, let's say, somewhere around there. Eventually we put it into an LLC. And there are some clients that want to put it into an LLC right off the bat. Their first property, they want to put it into an LLC right off the bat. That's perfectly fine. What you're going to have is just a higher cost and more hassle, right? More record keeping to make sure that you don't pierce the corporate veil to keep your LLC different from your personal accounts. More costs, a few $100s a year more, and other costs and accounting and other things like that. So it can certainly be an opportunity for you. One thing I do want to mention, though, is if you are buying it in your personal name, you're using conventional financing, that means you're closing in your personal name. If you deed it into an LLC, there's something called the due on sale clause that you'll want to pay attention to. This is something that gets a little bit more specific, but you need to make sure that you're abiding by the right way to deed it, because you could actually trip what's called the due on sale clause and end up in a situation where you actually have to pay off that mortgage that you just took out in your personal name. You don't want to do that. But David, something that my team would talk through before we got there with you. This is a normal part of a call prior to property selection. So don't worry, you'll be set up for success, and hope this helped.
All right. I'm just going to trust that all of that stuff was accurate because it was a lot of information. We're probably going to repurpose that. I'm going to have to watch this again to see everything that you said. But all I can think of is making puns with the word deed. Like I did not understand that. But anyways, I thought that was great. Jen Filzen, who is our past contributor here on the show, past guest on the show, client, says she has all 3 properties in her name and it's moved into my living trust. And she also put that she's here in Jacksonville for vacation right now. And it's awesome. Jen, tell us in the chat. Is this a tax expendable trip because you have properties in Jacksonville? Just let us know. All right, great. So moving forward,
I gotta give a shout out to Jen and Renee. So good that you guys are here. I didn't know that you guys were here. Pablo actually told me right before we jumped on the show that you guys were here. So you gotta, the office is closed to guests right now, but let's try to get together before you guys head back.
Maybe they can play spike ball with us on Sunday morning. You never know. Maybe it's a beach day.
There you go.
That's COVID compliant. All right, back to this property, Greg. Let's dive in. Right. So first things first, we like to describe this stuff because we're repurposing this into podcasts. So our friend that's listening here in the future, and we're in your ear, we want to tell you what everybody else is looking at. We're looking at a house that is $180,000 it's a 4-bedroom, 2-bathroom. It's in the 32205 zip code. Greg, is that one of your go-to zip codes? What part of town is this?
This is on the west side of Jacksonville. Absolutely one of our go-to zip codes.
Awesome. Okay. So west side of Jacksonville, that is the one that's close to like the naval base, or is that close to downtown as well?
Yeah, this is sort of right in between the naval base and downtown Jacksonville. Downtown Jacksonville has 55,000 jobs and the Navy base has over 20,000 jobs. So you're in a good spot there.
All right, sweet, good spot. So that being said, 4-bedroom, 2-bathroom house. It's got a driveway parking. It has a estimated rent range of $1,275 to $1,325 that we're going to get into. It's leased already for 2 years. And here is what you really want to know. And it is that it is cash flowing on day one. Estimated conventional financing total monthly cash flow is $242. And your estimated conventional financing total ROI is 9.72%. Greg, let's break down for the uninitiated that monthly cash flow number. What does that include? How does that look like?
So your monthly cash flow, you should think about what hits your bank account on a normal month with a rental property. So specifically what this means is the rental income that comes in, and then take away the interest, the principal, the property taxes, the insurance cost that you pay every single month in your mortgage payment, and then take away your property management fees. And then what you're going to be left with here is roughly $240 a month on a normal month.
Okay, great. And that is $42 a month that you are free to invest however you want, but you also get a portfolio manager at JWB that checks in with you once a month, kind of tells you, like how much you should be saving or whatnot, right? Is that accurate?
Oh yeah, absolutely. Well, we're building that plan with you even before we get to property selection. Once you actually own your properties, then every single month you're going to have a call with your portfolio manager, and those calls will vary. Sometimes they'll be more transactional. It will be, hey, here's what happened on my rental property this month, or this is when the lease is scheduled to come up, or whatever it may be. And then some of those calls are going to be more high level. Okay, hey, we understood what the plan was 3 months ago when we built the plan. Has anything changed? What should we be thinking about now? Is there an opportunity to maximize the plan and get you to your passive income goal sooner? And so, yeah, so that's of course built in.
Makes sense. So tell me about this total ROI, 9.72%. What does that entail? What is that different from cash flow?
So that's your return on your investment. And that's going to take into account all of the good things and all of the bad things that come along with investing in this rental property. So the good things are your net rental income. Your net rental income would be your gross rental income, the rent that we receive, minus all of your expenses. So we talked about some of the expenses being the principal, the interest, the taxes, the insurance costs. We've also talked about the property management fees, but we're also going to include here your tenant placement fees, right? When JWB places your tenant in your home for you, there's a fee for that. There's a fee for that for all property management companies, or most that I know of. So we need to account for that fee in your return on investment, right? It's also going to take into account expected maintenance and expected vacancy costs. So that's taken into account. Those are negative items, right? Take all those items and that gets to your net rental income. And then we're also going to add in a couple of things that you might not be thinking of that do happen. So you've got your tax savings, because real estate is such a tax advantageous asset. You're able to write off a significant amount through a lot of things, and specifically property depreciation is what we're referencing here. And so that's going to result in some tax savings for you. So that's a part of your return. We're also going to include the principal pay down, because Pablo, you're going to own your first rental property in hopefully soon. When are you scheduled to close, by the way?
December 14th is my closing date.
No way.
Yeah, pretty
Man, that's awesome. I didn't know it was that close.
Yeah.
So when you are closing on that property, that resident is going to be paying the rent. And because you're earning positive cash flow on it, who do you think's paying your loan down for you?
I'm going to assume my resident.
Your resident. Your resident. It's like a Christmas gift every single month for you, right?
Every month.
They're just taking care of you every single month. So that is what we call principal pay down. And that's a real return, right? That's somebody else paying Pablo's loan down for him. And that's what it would be for you on this as well. And so takes into account your net rental income, your tax savings, and your principal pay down. You take all of that and you divide it by your initial investment. And that's how you get a 9.72% return on investment here.
Okay. Now, I would be remiss not to bring up the fact that right here it says 0.00% appreciation rate, Greg. Can you tell me why you're not including appreciation in this estimate? And then we can kind of fudge with these numbers, and not fudge, but play with the spreadsheet and show the power of compounding interest.
There you go. So Jacksonville is known as a growth market. That means that historically we have appreciated at a higher rate than the national average. And Jacksonville, actually, if you compare it to cash flow markets out there, Jacksonville has appreciated 34% more on average than comparable cash flow markets out there, such as Dallas, Birmingham, Kansas City, Cleveland, and Memphis. 34% more. So it's always intriguing when you see that appreciation rate there at 0% on our evaluations. I'm glad you asked, Pablo. And the reason that we do this for a couple things. When you're counting on home price appreciation, you really need to make sure you have a buy and hold outlook that spans a full market cycle. Because the way home price appreciation works is that it repeats itself if you give it enough time. If you go back and you look at 10, 15, 20-year segments in your market out there or in Jacksonville, you're going to find that the rate of appreciation there is very close to the long-term historical appreciation rate going back to 1991. So what that shows you is if you give it enough time, history repeats itself, and that home prices appreciate close to that historically accurate home price appreciation rate. So in Jacksonville, that rate is 4.3% per year on average. And that's from the Federal Housing Finance Agency website that's going back all the way since 1991. But the thing is, you have to be invested for a full market cycle. So going back to why we initially put 0% here is because I don't know if you're going to listen to me and invest for a full market cycle. I hope you do. That's when you get the biggest gains in rental properties, is from appreciation over time. But if you're invested for 3 years or 5 years even, I don't think you can count on home price appreciation because it is somewhat speculative there. So that's the real reason. If everybody I knew was going to commit to at least a 10-year hold or a 15-year hold or a 20-year hold, we would put it there front and center. But that's one of the reasons. The other reason is that, when you put in 4.3% here, Pablo, you're going to see a pretty large jump on the return on investment. So why don't we do that?
Yeah,
there we go.
Done.
Man, spot on, right? Our return on investment just jumped to 25%. Honestly, it feels, we don't want the deal seekers here coming to this asset class. We want people who want consistency, who want a time-tested, proven asset. And literally when you put 25% as a return on investment in front of people, it brings people that are somewhat speculative. And so we tend to make, the 10% return is a solid return compared to other asset classes. It feels a little bit more natural than coming out here and saying this is going to be 20, 25%. That's a part of it. And then at the end of the day, we want to under promise and over deliver. 10% returns or wherever we are, 9.7% on this property is a fantastic return. And we want to make sure that after holding on to your money for 10 years, 20 years, we can come back to you and show you that we were a little bit higher, or hopefully a lot higher than that.
Yeah, man, I'm hearing a lot of what you're saying, and I'm thinking about our Tuesday call with Abram, right? And he was talking about how at first he had to realize that, JWB at first he's like, man, these returns are terrible compared to other people, and then he realized, oh, it's because they're not including that ROI from appreciation. And then once he started factoring in, he's like, oh, okay, so now it's comparable. Now this is a really consistent asset. It's what you're doing. Greg, real quick, and we'll go straight into the rest of the questions and some of these like unique things about this property. Mm-hmm. But can you explain why it goes from, when I have it here at 0%, right? It's at 9.72. And then when I go to 4.3%, it jumps up so dramatically to 25.72.
Mm-hmm. Yes, absolutely. That comes down to one of our best friends in real estate. That's leverage. And that's using conventional financing, using financing as a tool to help you accomplish your goals. See, what people many times lock in on is an appreciation rate of 4%. And they assume that that is going to equal their return on investment. But if you are using conventional financing, let's say that you put 25% down. If your asset is growing at a 4% rate, but you only put 25% down, your return on your asset is actually, your return on investment from the appreciation is actually 16% in that example, because you only put 25% down, right? If you want to put this in your phone and do a calculation right now, do 4% over 25%. And what you're going to see is it's going to be a 16% return. So the asset value, the market value of the property goes up. You get the full benefit of that because you're the owner, but you only have 25% of your money in the deal. And so that's why I'm a buy and hold investor. That's why I preach this for our clients as well, is because you can own this asset. And over time, if you hold on for a full market cycle, history shows us you're going to get a really substantial appreciation rate. And if you combine this with conventional financing, this is how you can supercharge your returns and make, even much higher than 10%, which is what Abraham found out as well, and brought him to JWB.
Yeah, man, I'm really pumped to I'm really pumped to realize those gains, right? Like the idea that I have, I made no bones about it on my call, right? Like I have about like $110,000 for investing, and the idea that I can put 28 into something and get the benefit of having invested $120,000 is it's a major game changer that I learned by being here.
That's one of the reasons that people love real estate so much. It's because the property is great, right? But at the end of the day, it's the property matching it with the financing opportunities that really allows you to earn incredibly high rates of return. And if you can couple that with a team that makes it easy for you, then it becomes this incredible opportunity that you buy one and you're like, well, awesome. It pays for itself every single month. I've got a team who's taking care of it. How can I turn that into 2 or 3 or 4 or 5? That's when it becomes fun. It becomes scalable. You need the team to make that happen. But if you can put it all together, that's when this just can be a great part of your overall financial plan.
Awesome, man. So I want to jump into some of these questions. You mentioned a couple keywords here I want to get into. You mentioned team and you mentioned property. And I feel like what's going on in the chat right now, I got to acknowledge it, right? Like Jen and Lee are going back and forth. Jen is talking about asking for Marilyn. Marilyn is actually on this call. I don't see her on the chat, but she is on this call as she is every week. And I just really want to acknowledge our community. I think it's really, really cool that people are really getting to know each other here and seeing each other week after week. For those of you that don't know, we have a Facebook group where everybody also interacts, so you get to know each other a little bit better. It's at jwbfacebookgroup.com. I used to call it our cool club, our secret cool club. Now it's a not so secret cool club because there's, Marilyn's driving. There she is. Cool, Marilyn. I'm glad. Keep your hands on the wheel, Marilyn. Yeah. Still the cool club. You're right, Jen. Just not a secret cool club anymore because there's 1,900 people in it now. Right. It's grown dramatically since we started this thing in January. But if anybody's here and you don't understand why everybody has inside jokes, that's what's going on. And I just want to make a recommendation that once you're there, check out Jen and Renee's Facebook profile. They've been posting, they're like dance instructors. They've been posting dance videos. It's been unbelievable. It's like my favorite follow on social media now. But anyways, let's get to the real estate stuff. You talked about the property. Hari Subramanian, I hope I'm getting that correctly. Maybe it's Ari. Ari, let me know. He asks, can you share more details about the property condition? Can you tell us a little bit about the condition of this property, Greg?
Yeah. Man, let me see. I had it in my email. I know that the roof, so we have let me kind of go high level. I actually asked some of the specifics on it before, so I can probably look those up. But every time that we sell a property, it has to meet the JWB standard. So this is one that's been in our portfolio, but before we make it available for clients, we're going to make sure that we inspect it and that all the mechanicals meet our standards so that you're not left with deferred maintenance. So we've gone through and we've checked when the roof was replaced and the AC was replaced and all that good stuff. We can share all that with you. Of course, if you talk with my team and have some more maybe in-depth conversations, that's all shared prior to property selection. So at the end of the day, whether it's a brand new construction home, which we sell, or it's a renovation, there's a standard that has to be met. And to make sure that you don't have deferred maintenance, meaning that you don't have major expenses coming down the pike from your major mechanicals on the house, roof, plumbing, electrical. Those are the things that can really be backbreakers for you.
Yeah, cool. And I think this is a good time to talk about two things. One is the idea that you offer new construction homes and renovation homes. So this is clearly I guess this is kind of unique because you've owned this thing as a internal asset since 2008, right? But like this would qualify as a renovated home, right?
Of course. Yeah, absolutely.
So can you tell kind of the difference between your new construction offering and your renovated home offering?
Yeah. So, I mean, there's the obvious, right? New construction was just built, right? It was just built this year by JWB, and then renovations were just renovated. And so, I mean, obviously that's not groundbreaking that I just shared that. But the thing, but the thing that will surprise many people is that new construction and renovations largely come back to the same return on investment expectations. So we get a lot of questions, which do you prefer, new construction or renovations? Many people are surprised that I don't have a preference because I own both of them. If you actually look over the years, I have more renovated homes in my own portfolio than I do new construction. Now, a lot of that is because I started to invest in 2006 and I got a big jump up on renovated homes. We started to build new construction in 2011. But at the end of the day, I love them both because they can both return the same amount. It's just different as far as how you get to that return on investment. So for a renovated home, you're going to see lower purchase prices. So typically our purchase prices will be between about $150,000 to $210,000. And your renovated homes will largely be between about $150,000 to about $180,000. And so with a lower purchase price, what you're going to see, that's going to help you keep your cash flows strong. It's going to keep your return on investment strong. What that also is going to do is to give you a lower property tax burden because that's largely tied to your purchase price or the market value of the home. So lower taxes for a renovated home. Now on the other side, you're going to see slightly higher property insurance costs. And this is just because of the way that insurance providers, assign premiums. It's based on the risk level and it's based on building codes as well. So on the other side, new construction homes have a lower insurance cost. And that's really because building codes have improved so much over the years. So your property insurance cost on this one, about $1,000, $1,056, that's going to be higher than what it would be for a new construction home. So that hurts your cash flow there for a renovated home. And then the other thing is on the maintenance side. Your maintenance percentages are going to be slightly higher for a renovated home than a new construction home, right? It was built many, many years ago. And that's just what we have seen over the years. And we've actually tracked this for thousands of properties that our clients have purchased since 2011. We've tracked it. And so your maintenance percentage for a renovated home is 6% of the gross rents that are collected. Whereas a new construction home is going to be slightly less. It's going to be 4% of the gross rents that are collected. But at the end of the day, right, renovations, lower price, lower taxes, higher insurance costs, higher maintenance costs slightly, it gets you to that 9 to 11% return. New constructions have a higher purchase price, have higher property taxes, lower insurance costs, and slightly lower maintenance costs. You're still between that 9 to 11% return. And then another question that a lot of people say is, well, are they going to appreciate at the same rate? Yes, they do, right? If you're holding on to this thing for 10 or 20 years, the rate of appreciation for a home that is 20 years old versus a home that's 40 years old is, there's no difference, right? That's not something that people see, that homes built in 1980 appreciate more than homes that were built in 1970, right? It just doesn't, it's not affected that way. So appreciation can be assumed to be the same between a home that's held for a full market cycle, that's new construction today versus not. So at the end of the day, I love them both. You can get the same returns no matter how you get there. We're able to get really quality residents in there and keep them there for a long time.
Love it, man. Yeah, I love when you say that the new construction home is only new construction the first month that you own it, right? Or like the first year that you own it. After that, it's just a home, right?
Yeah, probably the first year. I mean, if you were trying to sell that new construction home in a year or 2 years or 3 years, then you would probably get a premium versus a home that was built 50 years ago. But you're not. You're going to be holding on for a long time.
Got it. All right, we got one more great question here from Dominic Albano. Dominic Albano. All right, I'm just going to go with it. I am not pronouncing names today well, so hold up with me.
I think that's kind of like your thing, Pablo. You're such a wordsmith, and when it comes to names, you just butcher them, bro.
It's true. I had never really connected the dots. I'm really good at regular nouns, very bad at proper nouns. All right, Dominic Albano. Dominic Albano. What are some of the tax deductions you can take from some of closing costs that include buying down points, etc.?
All right.
Like my cadence there wasn't very good, but what are some of the good tax deductions that you can take from closing costs and et cetera?
Okay, well, let's talk about tax deductions in general. Closing cost is one of the tax deductions that you can take, but there's so many. There are kind of what I call your cash event deductions, and there's a non-cash event deduction. And if you had to choose between a cash event deduction and a non-cash event deduction, Pablo, which would you choose?
I would say a non-cash event deduction.
Yeah, because a non-cash event deduction means that you didn't actually have to pay for it. The money didn't have to leave your pocket, but you're still able to write it off, right? So real estate's incredible because you get to write off the things that actually leave your bank account, like your property management fees, right? Your maintenance costs, right? Your interest costs on your loan, your property taxes, your insurance, all those things. When you pay for those are written off, meaning that you don't have to pay taxes on those, right? Those are written off. Those are cash event deductions. But the thing that just absolutely is incredible about rental properties is this non-tax deduction that we talk about a lot, Pablo. What is the incredible non-cash deduction that we love?
Depreciation. I was about to say appreciation. It's depreciation.
Well, I have a serious appreciation for depreciation.
I bet you do.
Write that down.
Okay, you're the wordsmith now.
Depreciation. So what we're talking about, it is not talking about market value depreciation here. We're talking about building depreciation and the fact that the IRS says, hey, listen, things are going to break down over time. And generally, the easiest way to think about this is they assume that it's going to break down over 27 and a half years. Your building is going to depreciate over 27 and a half years. And so what that does is it gives you this write-off every single year, even if nothing broke. You get this write-off, right? That might be a $4,000 write-off or a $5,000 write-off every single year that you get to take. And it takes away from other gains in real estate that you might have had to pay taxes on. And so that is just an incredible, I don't know if people get as fired up about taxes as I do, but that non-cash event deduction is incredible. And so we get that. And I think Dominic asked about buying down points or buying down your rate with points. What he's talking about is you can actually pay more to get a lower interest rate on your loan. And depending on how long you're going to be holding the asset, this may make sense for you to do. And if you do that, you can write those off, right? Those are parts of your closing costs that you can write off as well.
Greg, I like how you get excited about tax savings. And Jen is saying here in the chat, Greg is a tax nerd, LOL. Jen, you have no idea. We realized how much of a tax nerd Greg was when we had been struggling through getting past like our 4 mile run that we do on Tuesdays and Thursday mornings. We had taken a couple of weeks where we couldn't complete it. And then this one time I started asking Greg about taxes, and all of a sudden we look up and we're like 4 miles in, we're going faster than ever. And it's just Greg super jacked up about taxes and me with my tongue out, not being able to keep up. So yeah, you have no idea how deep that rabbit hole goes.
Yeah, you can tell. I don't have a lot of friends. The guy who gets fired up about tax savings he's not the life of the party.
I don't know, man. We got a good party going on right here. All right, Greg. I would love to hear the story about, you told me a really interesting story about this house. Number one is the idea of how you owned it before and why you're offering it now. Can you talk me through why that's happening?
Yeah, absolutely. So, the environment right now for real estate investors, rental property investors, is that there's just not a lot of inventory out there. And for many people on the call here, on the show here, I would imagine if you've reached out to other providers in different parts of the country, you've been met with them telling you, hey, listen, we don't have anything to sell right now. We don't have any inventory. And because what's going on is there's just an extreme shortage of inventory across the country. And what that means is that prices go up when there's a shortage of inventory and demand is strong. So prices go up. So for inventory providers out there, it makes it tough on them. It's really tough for them to source inventory right now because their acquisition prices go up. But the problem for turnkey providers, if you put your turnkey provider hat on right now, is you might say, well, that's fine. They're just going to buy it for more, but then they're going to sell it to me for more. Sell it to me for more and more and more and more and more. But it doesn't work. If you're like JWB and you have to produce a return on investment and to produce positive cash flow, if you go to a certain height of the market there, you're not going to be able to produce positive cash flow. So this is what inventory providers across the country are experiencing right now. It's that their acquisition prices go up and up and up, but they can't sell it for more than this, right? Because if they keep going up and selling for more, they're not going to produce positive cash flow for you. So this is a challenge everywhere across the country. It's not a challenge for JWB though, and it's because we saw this coming. We saw it coming many, many years ago. And, JWB this year will sell about 450 properties. In past years, it's been 400, 350, whatever it's been. For many, many years now, JWB has been buying 600, 700, even 800 properties a year. And a lot of them have been lots that we sit on. And the reason that we bought so much more than we were even going to build that year is because we realized that this was going to happen. And this was going to put our clients and our company in a big risk if we just had to rely on buying inventory today to sell. And so we have a couple of different buckets of inventory to make sure that clients have a runway to be able to purchase. Because clients come to us and they want to buy 5, 10, 15, 20 properties. They want to do that over a number of years. So one of those buckets is that land that we have acquired. And we continue to build that out to make sure that we have enough new construction homes for our clients. Another bucket is the homes that we have renovated that we have held on to over the years, right? So I have over 300 homes in our portfolio between my business partners and I, right? Those are the ones that we're holding, but there might be, I don't know, another 100 there that are just there in case clients need extra inventory. And sales have been really strong at JWB lately. So sometimes there's a lot of sales that happen and we never go back to clients and say, we don't have something for you. So we have a lot of different buckets here. Short term would be kind of this bucket like Crestfield, like very easy for us to take a performing asset, make it available for a client. It's in the same neighborhood. We have a great resident in place there. And then long term, we build out enough inventory to make sure that we can match demand, years in advance.
So when you're telling me this, Greg, I'm hearing you have a long-term bucket and a short-term bucket. I have to assume that you tap into that short-term bucket when there are moments in time that you're not able to build fast enough to put stuff on that land. Can you kind of tell me why you think that is? Like I have to assume that when you're in that short-term bucket, there's an elevated level of demand and a decreased level of supply, right? In a time window that you haven't been able to ramp up long enough to get into that, right? But you have that buffer. Can you tell me kind of why you think that that's going on right now?
Yeah, yeah. Well, it takes what, about 6 months or so to build a house. So when you're planning 6 months in advance, you're planning for what do we expect our sales volume is going to be 6 months from now? How do we make sure that we have that met plus enough, plus more than that to make sure that we have, adequate demand there? Well, been a couple of curveballs that have been thrown at us lately here this year. COVID was a huge curveball. And so while that didn't change our company plans at all, we continued to buy and buy and buy. And we obviously everybody on our team was able to stay employed and we didn't have to let anybody go and all of that good stuff. And rent collection has been fantastic and whatnot. But one of the things that we did is we took our foot off the gas a little bit as far as how much we were building. We dropped our number of builds from probably about 30 to 35 a month of completed starting and completed to about 20 or so. And so this was us just saying, hey, listen, we know where the market's going, but there might be supply chain issues. There might be other things, that may happen. We'll say, let's pull back a little bit. So, when that happens, then you're going to feel the effects of that 6 months down the line, which is kind of where we're at now. Now, at the same time, sales have been really, really high. 2 months ago, we sold the most properties that we ever have in our company history. I think it was 88 homes that we put under contract in a month. And our business plan calls for us to sell about 40 a month. So, and months since then have continued to be very strong. So you kind of got those two things happen where you took your foot off the gas 6 months ago, slightly because of COVID when it came to how much you're building. And you've had a huge surge of demand really for the last 5 months or so. And then you might eventually get into this bucket that you might get to Crestfield. But there are so many things that have to happen for us to even get into this bucket. And the reality is that we have hundreds of properties just like this one, even if we would get there, which is such a cool thing, right? And I got to give a lot of credit to my business partners for this, because I wasn't the one out of the four of us who was saying, 8 years ago, hey, we need to stockpile this much inventory. I'm pretty conservative out of the four of us for sure. And I look back and they're like, hey, we need to do this. There's going to be a time. And then they may wanted to go 100%. And I might have said, hey, let's do 75%. Well, we went 100%. We acquired all of this land, and it puts our clients in a position of strength to make sure they can hit their goals. It puts our company in a position of strength. And there's really not any other turnkey providers I know out there who have inventory at this level right now. And it's a credit to their foresight. Yep. Hey, buddy, I think I lost your. Oh, there you go.
I was on mute. There's some landscaping going on outside, and I'm kind of freaking out about the volume. It's the way that you get excited about taxes is the way that I get excited about business. And every time that you go into like all this like redundancy and planning and foresight that you and your partners do, and then that the team executes on so well, is when I get all super jacked up. So maybe that's what we got to do when we go on our next run, and I can't handle it. The other thing that I love to hear is how committed to the idea of a win-win you always are. So, and I would love to hear the narrative on what's happening in this individual property that explains why, we talked about in the beginning of the show that there's a $4,800 rent credit. Can you tell me what's driving that rent credit?
Yes, absolutely. So when we say rent credit, we should probably really define like what that is, right? So for the client who purchases this home at closing, they are going to receive $4,800 as a credit at closing, like real cash to them at closing, which is interesting because usually you receive a credit if something went wrong in real estate, right? Like, something broke, right? Oh, okay. The seller is going to give a credit to the buyer. No, everything's going right on this home, right? The home is up to our standard renovation, right? The home is already rented. And the resident is already signed up for a lease that ends in 2022. So everything is right. So why would JWB be giving you a rent credit on this one? Well, the reality is because we need to do that to make sure that we can put you in a position to accomplish your return on investment goals. There are some times when JWB has a home that is under rented. And that's the case that you see here for this house on Crestfield. This house is under rented, and there's a lot of reasons why. Maybe we'll have time to go into that, but there was an extenuating circumstance. We had this home in our own portfolio and we decided to under rent the house for this resident. Now we looked at our surging sales, we looked at our inventory, wanted to make sure we always have enough inventory for the clients who are going to purchase this week. And we said, okay, well, this would be a great one for us to make available for clients. Oh no, hey, listen, this one's under rented. You remember that we did that? Okay. So then we look at it and we said, well, in order for us to be able to sell this asset at market value and to deliver that 9 to 11% return, we're going to need to make sure that we assume that the rent is at market value. Right? So the rent market value on this one is actually $1,300 a month. It's actually rented for $1,100 a month. So the way that we make sure that our clients are in a good position is we just give them the credit for the difference right off the bat. So that $200 a month times 24 months is equal to $4,800. And we know when we do that, we're going to give our clients a great chance to be able to hit their returns on investment. And now it becomes a sellable asset. Because if we didn't do that, JWB wouldn't be able to sell this asset. It wouldn't produce enough returns for clients and we wouldn't be able to sell it at market value. So this is us being able to make it a win for the client. We're able to make it a win for the resident who is here on a reduced rent today, will be ramping up over time. So they get to stay in this home. And then it's a win for JWB as well. So that's really where it comes from.
I love it, man. I think that's genius. What Karen Jensen is putting, do you have a link for Tuesday's call? I only found the mixtape link. I would like to explain that. So our podcast gets, cause I'm in the chat right now, right? Like Byron's asking about education. I'm sending people to chat with JWB, not chat with JWB, notyouraverageinvestorshow.com to see our past episodes and get to everything. Our podcast, when we repurpose this, it comes out in audio about 4 to 6 weeks later, depending on the amount of content we got going on. The property breakdowns come out a week later because we want it to be as live as possible, but the interviews come out a little bit delayed in order to be able to meet that. So if you are looking for Tuesday's call, you got to go to either notyouraverageinvestorshow.com and watch it on YouTube, or you got to go to our YouTube channel and watch it on YouTube, which you can easily find the YouTube channel by either searching Not Your Average Investor Show or searching JWB on YouTube as well. Or third option is it's in the Facebook group. If you go to jwbfacebookgroup.com, join the cool club, and you get to see it there as well. We always put the last Tuesday interview as the highlighted segment, so you can see it there. On that note, she mentioned the mixtape, which has kind of been my baby. And that is, I had to talk Gregg into it, but Gregg allowed me to take the webinar and make it into a musical album with his glorious voice over some beats. So I would love to hear any kind of feedback. If you listen to that, it's like making a mixtape for your friends, right? It's like 5 songs, 18 minutes. You get to listen to it. It has all the meat of the webinar, but I'm trying to make it entertaining. I'm trying to make it easy for you to listen to and for you to share with anybody that's interested or whatnot. So if you have listened to the mixtape, I would love to hear some feedback on that because I'm super insecure about it.
You know, I kind of want to hear the feedback on it, but I have a feeling that people are going to dig it, and I almost don't want that to get that feedback because I know you're going to do more and more of it. I'm a little insecure about it as well, brother. I mean, there's not too many things that I feel a little bit like out of place rather than Gregg talking about tax savings on a mixtape, but you know, whatever, man, we'll let it roll.
Yeah, and I'll find the link and I'll put it in here as Gregg is talking over this next question. But it's really just our last episode on the podcast. So if you go to whatever your favorite podcast platform is, it's going to be the last episode that came out, and you can find it on iTunes, Spotify, whatever you listen to. Arthur Haber has a question. Can you go over how you're getting a 9% return?
Yes, Arthur, absolutely. You know, I'd say, do we want to be more general or do we want to go dig into the numbers? Pablo, what do you think?
Why don't you start with general?
Okay.
And Arthur, if you have a specific dig in that you want us to get to, let us know in the chat, and we'll dig in big here.
Yeah, absolutely. So when we're talking about your return on investment, what you're doing in the top numerator there is taking all the good stuff. That's the net return, right? And then you're going to divide it by your initial investment. That's your return on your investment, right? So on the top stuff, right? We're talking about net rental income? Well, there we're taking your gross rental income and we're subtracting all of your principal payments, your interest payments, your property taxes, and your property insurance costs. We are also taking away your property management fees, meaning we're minusing out your property management fees. We're taking into account your tenant placement fees as well. So these are costs to you. And then we're subtracting your expected maintenance and vacancy costs. So you take all that away and you get your net rental income. All right. The next thing that we're taking into account is your tax savings. So we were just talking about that non-cash event from depreciation, as well as the cash events of tax savings, right? Being able to write off your interest costs, your property management fees, your insurance costs, taxes, all those good things. What you're able to do there is to see the value of the write-off. And specifically, we're looking at the depreciation write-off. You multiply that times your expected tax bracket. And what you're able to see is a real dollar value on the taxes that you did not have to pay today, right? And so that's keeping money in your pocket today. And that's a real part of your return on your investment. And so that's the tax savings component. And then the next component is the principal pay down, right? Just like Pablo's new resident that when he closes on his home on the 14th, right? His resident's giving him a gift every single month when they pay rent, because that rent payment is going to Pablo. And because Pablo has positive cash flow coming from that rent payment minus his mortgage payment, that means that that mortgage payment is being made. And part of that mortgage payment is the principal part of it, right? There's the principal and the interest. Well, that resident is making the payment to Pablo, paying that mortgage payment, and then leaving him with some left over. So they're actually paying that principal payment down for him in his loan, which is incredible. So you add up the effect of that over an entire year, and you're able to see, well, what's the annual return on your principal pay down? So that's the top. And then you divide that by your initial investment. Your initial investment is your down payment on the loan plus your closing costs on the loan. And you do all of that, and you'll get between 9 to 11% returns for the Jacksonville market with JWB.
There you go. Easy peasy. So Arthur's actually commenting that in his option, tax savings should not be factored in. So I'm not sure what you mean by that, Greg. I don't know if you have insight into why that would be, or do you have any insight into why you wouldn't factor in tax savings?
I do. So if you're deciding between one market to the next, like if you're in rental properties, it's not like you get tax savings here in Jacksonville that you don't get for a rental property in Sheboygan, right? These are tax savings that are there for you because of this asset class, with a couple of little things to talk about here. So many of our clients are coming from a different asset class. So they're coming from the stock market, right? And then they're coming into rental properties. In that case, this fully would be a part of their return on their investment. If Arthur is coming from another market, I love Sheboygan. Sheboygan sounds like a great market, right? Probably
it's
not
a great word to say, right? Sheboygan.
Arthur's in Sheboygan, and he's looking at what's comparing apples to apples for return on investment here. He's not going to get tax savings in Jacksonville that he wouldn't get in Sheboygan. However, one thing to keep in mind here is many times the tax savings in Jacksonville are higher than other cash flow markets. And this is because purchase prices in Jacksonville are higher than in other cash flow markets. So if you're buying a house that's a $100,000 house, the write-off from depreciation for that house is less than the write-off for depreciation in Jacksonville, which is maybe a $200,000 house. So you typically do get marginally more benefit for being in Jacksonville if we're being technical about this. However, you don't get this specific tax advantage just for being in Jacksonville with JWB that you wouldn't otherwise get in another rental property in a different market.
Very illuminating. I had never heard that concept before, so happy to get that one in. And that makes me think, Greg, if I'm looking at a pie chart and I'm thinking about all the different profit centers, is there kind of like that tax savings piece? Let's say, what percentage of that ROI is that tax saving piece? Do you kind of have that in your head in any way?
Yeah,
Is that
about 3-4%. I mean, we could look it up if we want to get technical into it, but maybe about 3-4% or so.
3-4% of the nine, or 3-4% of the total kind of like ROI?
Yeah, so if you're looking at all the profit centers like we just did, and we saw that
Mhm.
it was about a 25% return on investment,
Mhm.
right? About 3 or 4% of that would be tax savings.
Okay.
3 or 4% of that would be tax savings. 3 or 4% of that would be your principal pay down. 3 or 4% would be your net rental income.
Mhm.
And then what's the rest of it?
Appreciation, the
Yeah,
leverage from appreciation and the exercise that we just did.
exactly. Which is why I really want people to pay attention to appreciation if you're buying for the long haul. It's because if you're not paying attention to appreciation, you're holding on for a full market cycle, you're not paying attention to the biggest part of your return on investment.
Got it. Arthur also asks, is the cost segregation already done?
Arthur, great question. So cost segregation, what he's talking about is an advanced strategy to be able to get more of a write-off from depreciation. So, how I mentioned how the IRS assumes that your property is going to depreciate over 27 and a half years. That's sort of the standard way. There are opportunities to accelerate your depreciation. And this is really common in commercial properties. It's not so common in residential properties, because what happens is, in order to do this cost segregation, you have to hire an accounting firm or a company that focuses specifically on it. They're typically pretty expensive, and you typically don't see a benefit. It's not worth it typically to spend, $10,000 in a cost segregation study to do it, to be able to save $2,000 on taxes or $4,000 on taxes. So you typically don't do it on residential properties. We don't do it on our single family residential renovated homes. So this is not assuming cost segregation is done in these numbers, Arthur. If you can find a way to get it done very inexpensively, the cost segregation study done very inexpensively, that would be great. It's just usually pretty tough to do that. So most rental properties investors don't do it on single family residential.
Okay, got it. So, we've been we're an hour in, Greg. I think that this has been super illuminating. Arthur, great questions coming in at the buzzer, right? Like, I thought that was really good educational moments for us. Jen, I have not been able to find the link yet because I've been enthralled in this last piece of conversation. But if you go to Arthur's got another great question. I got to do it. Are any of these properties in an opportunity zone? I know you love opportunity zones, Greg.
I do love opportunity zones. I don't know if this one is or not, Arthur. There are really great neighborhoods in Jacksonville that are opportunity zones. Let me first start off and talk about what an opportunity zone is. It's a program that was started, I believe, in 2017, where the government has identified areas that they want to increase investment in. They want people to be incentivized to create to do investments in, and they're called opportunity zones. And you'll want to do more due diligence, more research on this than I'm going to have time to go into. But basically, you get these incredible tax savings if you invest in these areas. There's a lot of stipulations to be able to get these tax savings. You have to renovate to a certain percentage and all of this good stuff. So I haven't checked the map specifically on this one, but what I would encourage you to do, Arthur, is to reach out to my team. We have that map. We could let you know if this property is in an opportunity zone. And if your structure is set up in a way that you can really benefit from opportunity zones, Jacksonville as a market might be your best friend, because there are a lot of neighborhoods that are right in our core neighborhoods that are opportunity zones. So reach out to my team.
All right. Arthur coming in again at the buzzer. Amazing. He's like overtime 3, like Ray Allen against the, anyways, I'm not going to get basketball nerdy. Listen, guys, I just want to thank you all for being here, right? Like, the idea that we can spend a full hour, I can spend a full hour talking with Greg and talking with everybody else in the middle of a Thursday, that you take your time out to spend time with us, is really something we never, ever, ever take for granted. And like we said, this show is for you. So those questions make the show, these stories that we tell, in order for you to teach them, the way that you ask them really helps us teach them in a way that we haven't done it before, which I think was illustrated well today, right? Because I learned a couple of new things that after a year of doing this, I had never heard. So I thought that was really, really awesome. On Tuesday, we have a guest called Ken Moline. Greg, you want to tell us a little bit about Ken?
Ken's incredible. Ken is, I mean, we were just talking about his story before here.
Yeah.
So if you want to, a lot of people say, oh, well, should I really be buying properties when I get closer to retirement? Should I be using financing when I get closer to retirement? And you've even heard me say, well, generally speaking, people use financing when they're a little bit earlier on in their investing stage, right? Generally, as people get closer to retirement, they may want to eliminate debt. And we've talked about the fact that even though it would still be a better return on their investment to be able to take that debt on and buy the asset, they say, you know what, that's not my highest priority. Well, Ken's a great example of somebody that looked at the numbers. And I believe what was he, when he started to invest in rental properties with a 75?
75.
75. And he did it for retirement planning purposes and to have that income coming in. And has grown his portfolio 6 properties. Is that what we're at right now?
It's either 6 or 7.
6 or 7 now.
Yeah.
And has taken out financing, has done it in very creative ways. And we can kind of walk through why that makes sense, doing that as someone who is closer in retirement age. Why does it make sense to take out debt? So I thought it'd be a really great learning opportunity for us. I'm super excited to chat with Ken.
Yeah, by the way, started at 75, now he's 85 and he's got 7 properties, right? So like super, super interesting, right? Like I talked to Ken yesterday, right? Like I found the story of, realizing that hadn't planned, that he was outliving his original retirement expectations and then having to figure that out. I think that story is fascinating because I think that, as the boomers age and whatnot, right? Like that's my dad's age right now.
Mm-hmm.
So super, super interesting to be able to like, in the fourth quarter, right? Like, be able to like go to the well, still benefit from this asset class. It was very counterintuitive to everything that I had heard, right? So like, I think it's going to be really, really interesting. He's also a awesome dude that's had a really interesting life experience, right? Like he lived in like East Pakistan before it was Bangladesh for a while, and he grew up in Silicon Valley. So just an interesting guy that had his own business for a long time. I'm pumped up about it. I hope that you got value out of this call. If you're here with us today, check us out. If you want to talk to the team, go to chatwithjwb.com. If you want to watch the webinar, go to jwbwebclass.com. If that stuff is not working for you very well, if you go to notyouraverageinvestorshow.com, I heard today that we had a little bit of lag on the website. We'll get that figured out, but notyouraverageinvestorshow.com is working. And there's a link to watch the web class. There's also a link to chat with the team all over the website. So you should be able to find it. Karen Jensen is asking, do we have to register separately for Tuesday's show? Karen, good news, because you have registered for the Zoom call today. You're going to get reminder emails of when shows are coming up so that you can pick whenever you want to attend. So you're already registered. You're automatically going to be invited. If you don't want that, let us know. We'll take you off the list. No problem. But we find that, there's that value add. And again, I would love to, we talked a lot about the Cool Club this week. JWBFacebookgroup.com. Go there, join us, watch Greg do his walk and talks. He's extremely entertaining. He does watch parties, and we're starting to see a lot of value come from the aggregation of our community. And again, you may have noticed, right? There's people that have become friends here, which is really, really cool. So thank you, everybody. Greg, I'm going to leave it to you to give the last words, and we'll see each other next week.
Yeah. Well, thank you everybody for being here. Probably hit the nail right on the head. It's becoming a living, breathing community, which is just the coolest thing. If you were there day one, when Pablo and I were kicking around this idea, just to see his here a year later is pretty special, as a credit to everybody here. And then this home here, there's something special about this one. This one's actually available. There've been last maybe 2 or 3 that we put on this on the show here, had actually been put under contract a couple of days before as we were doing our preparation for it. This one's still available. It was just made available. So would really encourage you, if you like the numbers on this one, reach out to my team, go to chatwithjwb.com. And then if this one isn't the right one for you, but it sparked your interest, still go to chatwithjwb.com, because we have literally dozens of properties just like this. Because people can try to buy as much inventory as possible. They're not going to sell us out, though. I'll put that challenge out there to anybody. Just like the other providers are having inventory problems, we've got more than enough for everybody to accomplish their goals. So reach out, and we will catch you guys on Tuesday. Take care, everybody.